stablecoins, so bringing new products and solutions to our existing clients. The other area is about serving firms in the digital assets ecosystem. There's a whole ecosystem of fintech firms that are growing up in this space, and they need banking services. We will live in a world where TradFi and DeFi are going to live in parallel for quite a while. If not forever, and these firms need banking services. So how do we serve? That could mean liquidity, that could mean FX services, on and off ramps, which are really critical in this space. So bringing those capabilities to the fintechs and the firms in the digital assets ecosystem.
So good morning, my name is Larry Pruss. I'm a managing director at a company called Strategic Resource Management. We're a full service consulting company, advisory services. My area of responsibility is emerging and disruptive financial technology. So I get to do all the cool stuff like stablecoins, tokenized deposits, digital ID, quantum computing, artificial intelligence. We have a lot of clients, banks and credit unions, as well as fintechs that we serve that are very much interested in kind of this evolution of money, the digitization of all things money related, and obviously stablecoins and tokenized deposits fall within that realm. So glad to be here.
Great, thank you both. And just to build on what you said, that's what we're seeing as well on the Visa side. We're embedding stable coins across our infrastructure and starting to see some really interesting use cases pick up and learnings along the way. And so folks, in our time, what we're gonna do is three things. First, about 6 months on from the Genius Act, what boundaries has it created for the ecosystem? What does it take to launch and run a digital asset solution? And what is the 12 to 24 month outlook? And what should you be planning for now? But before we get into that, I wanted to ask for your help by getting out your phone to help with the Slido question. And our goal here, this one is anonymous, is to help ground us in terms of where we stand as an industry in terms of real progress. And this one also helps to get at some of the questions that I get that are implied in a lot of the conversations that I'm in, which is, am I behind, or what are others doing? So what we wanted to cover with you is, where does your organization stand today in its approach to digital assets? Are you actively developing or piloting a solution, live in market with an active solution, exploring proof of concept or internal research, monitoring the space, but not currently a strategic priority or not on your roadmap at this time? And Larry, while folks are answering, and yourself as well, what problem would you expect to be most in focus for those that are responding as having an active solution?
In terms of those that are responding, probably the big focus is the Genius Act, at least here in the US, the Genius Act, and there's 180 days kind of rulemaking that is going to be occurring. A lot of that outlining the requirements for issuing stablecoins, the requirements for on and off ramping stablecoins. So I would say those that are starting to get an early start on that, and there are a number of financial institutions that are doing that, need to be working very closely with your regulators and watching the legislation that's going to be coming out of Congress, whether that's kind of updates to the Genius Act by the Clarity Act, or again, the various rulemaking processes that the various federal agencies are doing. I think the earliest one out the gate was the FDIC, and they provided some guidance around stablecoin issuing requirements.
Fabulous, thank you. And Elizabeth, who do you think the end customers are here for those solutions?
Yeah, thank you for asking that question. I think that's really, really key. It's easy, there's so much happening in this space, and the technology is so interesting and enables so many different things. It's easy to just get enamored with it, right? With all the noise and the hype and the technology. I think fundamentally, it's certainly coming from a bank, right? We have to be smart about what we do and how we do it and what we prioritize. Grounding it in the end customer is so critical, right? So thank you for asking that question. I think that's really, really important. So anyone that's either, starting to think about it, or like when I look at the results here, thinking about a proof of concept, to me the biggest piece of advice and what I've learned over these many months is, think first and foremost, what's the problem that we're solving? Right? Who is our customer? What are we solving for? And that really brings clarity. The big use cases that we've seen and the end customers that we've been focused on, one is we see a lot of use cases in the B2C or C2B space, meaning marketplaces, firms that are in the gig economy that are paying employees sort of, and they want that sort of 24/7 or easy cross-border payments. We've seen a lot of activity in that space. P2P clearly is a big one, right? So remittances, especially in difficult corridors, people paying family members back home and across the world. But then the other one that we see that's quite big and really promising, and I think will disrupt and particularly relevant at this conference, is in the B2B space. And that may be initially a little counterintuitive, right? Because a lot of people, when we talk about digital assets, there's a lot of hype around 24/7, real-time, immediate. A lot of payments in the B2B world don't have to be, they have payment terms, right? They don't have to be immediate. They're not paying over the weekends. However, it brings a lot of programmability, which I think for the B2B payment space is really critical. We use the word smart money. So being able to program it, to have conditional payments, to have event-based payments, the data and the information that comes with the payments, that's where we're seeing a lot of interest in ways that the technology in the past was really struggling with enabling that, right? We all wonder, why do checks still exist in the B2B world, right? Why do firms pay each other? And quite frankly, it's because of the data, right? They can print the remittance information and the check, staple them together, and the payment and the data travel together. There's still a lot of inefficiencies in the B2B world that this technology now enables. So that was a very long answer, I know. But thinking about, because every bank has a different market, different clients, different needs, who is the client, what problem are we solving for, and staying very, very clear on that and not get lost in all of the hype and noise, because it's very easy to do that in this space.
Well said.
If I can add on to that, from a B2B standpoint, about 5% of businesses have exposure overseas, where they either have employees overseas or they're getting vendor payments overseas, and those people want to get paid instantly and in US dollars. So stablecoins very much solves that problem, so that handles that component of it. And then if you think about the US workforce, about 18% of our workers are foreign workers based in the US, and they are sending remittance home. That's another use case. And then the last one, you mentioned the gig economy. This number surprised me, but 30% of consumer businesses, workers here in the US are associated with the gig economy. And these people are living paycheck to paycheck. They don't want to wait till once a month or every other week to get paid. They want to get paid immediately. So they're seeking out instant real-time payment solutions, many of which are coming through the traditional payment rails, but many of which are coming through these new stablecoin rails, especially because they are by native programmable.
Well said. So really agree with what you both said. I think keeping that customer at the center, learning mindset, as this is a new technology, can be very clarifying in terms of those of you that are monitoring or still in that exploration phase. And what we're doing at Visa is doing co-design with our customers, lots of time interviewing them to really learn and be with them to understand what are the challenges that they're facing and how you might grow from there with this new technology, rather than starting with the technology and trying to apply it unilaterally across. Okay, thanks for your participation. We'll keep going with one more question before we dive more into the content. So our next question is, which forms of digital money is your organization actively evaluating or prioritizing? Stablecoins, tokenized deposits, both, or neither? So if I can ask for your participation again. And as these responses roll in, let's compare these responses against some of the foundational concepts created by the Genius Act legislation to see if it might be influencing them. So Elizabeth, the Act defines a payment stablecoin as a digital asset that is not a bank deposit. Mm-hmm. So for those in our audience that are prioritizing stablecoins, how does this distinction change the risk profile and capital treatment for a bank issuing a stablecoin versus a bank that's issuing a tokenized deposit? Yeah,
the easiest way to think about it for me is a tokenized deposit very, very similar. For all intents and purposes, it is like a traditional deposit. The technology underlying it is different and enables all the benefits we just talked about with the use cases. So it enables all those benefits, but it sort of acts and is treated from a regulatory, a legal perspective, FDIC insurance, accounting perspective. It is treated like a traditional deposit that has a mirror on chain. Mm-hmm. So in many ways, from a bank perspective, those are sort of an easier first step, right? It feels familiar, it is familiar. It's sort of an ability you can enter the space in a way that just feels a little safer and more familiar. Whereas a stablecoin is quite different, right? A stablecoin can be issued by a bank or a non-bank. So suddenly we enter into a world where we are competing and dealing with firms that are not our traditional peers in the industry. From an accounting and legal perspective, though, they're also quite different, both for us and for the end customer, especially in the B2B world, corporates. There's implications for them of having stable coins. And one of the biggest differences is a stablecoin has to be one-to-one backed against HQLA, a high-quality liquid asset. So there's all sorts of implications, both from a banking perspective as well as from the end customer. We believe, and it's interesting, I love looking at these results, and it's interesting that the majority here, or not the majority, but little less than half, but the biggest answer is both here. I find that interesting. I personally believe that, because I've talked to a lot of my peers in the last many months at other banks, and some are very much tokenized deposits, others are stable coins. I believe both will exist. We will move forward in a world where both will coexist. And as a bank, we have to be doing both, because the different use cases we spoke about earlier, some of them lend themselves better to tokenized deposits, and others lend themselves better to stable coin. So I do think, so I'm glad to see that the biggest answer here is both. I do believe that both will exist, and we have to be looking at both.
And for those of you, I know everyone in this room is smart enough to know this, but for those of you that aren't looking at your deposit outflows, look at your deposit outflows and see where those deposits are going. Just because your customers aren't asking for these solutions today doesn't mean that they don't need these solutions and aren't getting them through, say, third-party fintech type of relationships, because a lot of them, that's where they're getting them from today.
Yeah, I think that's great insight. And then if you're a bank who's thinking about what to do next, you picked up on a point for FDIC insurance earlier, and I wanted to ask you a little bit more about that. So since stablecoins are legally barred from FDIC insurance, how are you messaging the safety of these assets to corporate treasurers who might be used to more of a gold standard in terms of deposits?
It's a different way of looking at it. Early on when the whole debate came around stablecoins and paying yield and not, I heard a lot of news articles push the concept like, well, stablecoins aren't safe. They're not FDIC insured. They can't be FDIC insured. And I often would respond, well, of course that's the case because they're full reserve banking as opposed to fractional reserve banking. So stablecoins have to be fully reserved by cash-like instruments. So Treasury is less than 93 days, repos, reverse repos, bank deposits, those sorts of things. So in some aspects, they could be arguably safer than the traditional deposit. Where we need to kind of consider that difference, even from a treasurer, but also from just a general bank standpoint, is what happens when we see the next financial crisis. Like what we saw during SVB was we saw a lot of large depositors which understood the difference between like full reserve banking, fractional reserve banking, and what's insured, not insured, fleeing the SVB to other larger, more systematically important institutions. Well, if we have another one of those, they might actually flee to stable coins, which are fully reserved, bankruptcy remote, fully segregated, arguably a safer place to have it than deposits, particularly if you're a large depositor. So you're going to have to start looking at these differently. They both have different use cases, but stable coins, again, are that full reserve financial instrument that may or may not offer yield. We'll kind of talk about that later.
Yeah, great insight there. And what about any risks for tokenized deposits? How would you classify those?
I think, so from the end customer perspective, they're the same risk as a regular deposit. So no more or less risky than a regular deposit. From a bank perspective, and we will have to monitor this carefully, it's hard to see what the behavior might be down the road, but because they're more easily moved, right? We talked about that instantaneous 24/7 real-time movement of funds. Does it change the behaviors of customers? What does it mean from a bank's own liquidity management? What is the treatment of these deposits, and sort of, so that we have to think very carefully about that. Again, it's very early days. It's difficult to say what will happen. And in some ways, with real-time rails, we're starting, real-time rails also, you can move, 24/7 and all that. So I don't know that it will change things that drastically, but we have to monitor and just understand what is happening. I do think the other thing that'll be very interesting is as we move into a world with tokenized money market funds and tokenized deposits, do we see a lot more movement between those, right? If you're a corporate treasurer, even if you have just intraday balances, why wouldn't you move them into a tokenized money market fund and then just move them in and out, or even make payments out of your tokenized money market funds? So I think we're going to see an evolution of behaviors. It's a little hard now because it's so new, and these products haven't been around that long, and the adoption rate is not high enough to really be able to identify the long-term risks, but we're closely monitoring that.
Thank you.
One key distinction, too, between tokenized deposits and stable coins is who the liability lies with, right? So tokenized deposit is the liability of the bank. A stable coin is a liability of the issuer, who may or may not be a bank-related entity. So again, they're very different liabilities. Stable coins are more like a bearer instrument too. There's no pre-funding or anything like that. So there are some distinct differences between the two of them. Tokenized deposits are a lot more like a traditional deposit.
Well said. And so if we think about kind of these aspects together, and we stay on sort of predicting the future, given the Act prohibits stablecoin issuers from paying interest or rewards, which of course is a very active debate right now, one implication of this could be that stablecoins are used primarily for high velocity payments, whereas tokenized deposits are used more for institutional liquidity. Is that how you see it come into play?
It is, and again, early days, right? So no one has a crystal ball. But when we think of sort of money and what purposes does it serve, right? It's really three big purposes: a unit of account, a store of value, and a movement or transfer of value, right? So we think of those things. In the old traditional fiat world, we use the same tool, if you want, our underlying instrument, to do all three of those things. We're now moving into a world where, depending on what you're looking to do, you have a toolkit, different tools. So to your point, right, stablecoin, we may enter a world, and again, I'm thinking more in the corporate business world. I think retail consumers may be different, but in the corporate world, I could see a scenario that plays out, to your point, where stablecoins are used for the movement or transfer of value, and then tokenized deposits are used, or tokenized money market funds are used for the store of value, and they can move back and forth. So if any of you have heard this expression, right, the stablecoin sandwich, which means that you're using the stablecoin just for that movement. So you may go from either a traditional deposit or a tokenized deposit. You transfer it into a stablecoin to do the money movement around the world, because it's a lot more interoperable, right? Interoperability, as we all know, is critical in payments. So you use the stablecoin for that movement of value, and then at the receiving end, it's again moved back either into regular deposit, fiat, or tokenized deposit. So that's what we call a stablecoin sandwich. So that's, again, early days, what we're starting to see, but I think it's important to think about what are the different purposes, right? That unit of accounting, store of value, movement, transfer of value. What are we solving for? And recognizing we now have a toolkit, which is great, by the way. We have better tools that are better suited for these various scenarios and use cases, which is a great benefit to us and to our end customer.
I would argue that stable coins in particular do pose a disintermediation threat to a number of key businesses for traditional finance. So Obviously, a payment mechanism, if it takes off, it could pose some threat to, say, interchange and the card network. I don't think that's where a lot of the risk is with stablecoins. I think the initial risk is around deposits. Back in April of last year, the Treasury Department had done a study where they looked at potentially $6.6 trillion of deposit flight could be at risk of moving to stablecoin. And that was really dependent on a bunch of things. I don't think we'll see that much. But that's a fairly large base of the U.S. deposit base out there. And then the last one is stablecoins come from the crypto world. I wouldn't look at them as crypto, I'd look at them as a new payment rail because that's largely how it's being used in traditional finance. But with that, these things are programmable, and think about it as a digital dollar derivative sitting in a wallet or a digital wallet. You can put that to use while you're not using it for a payment. So I could enter it into, say, a liquidity contract or a DeFi contract and earn yield on it or lend it back out. So there's this whole other world around DeFi and lending that's about a $300 billion business. And as we think about some things that are being talked about today from a regulatory standpoint, I'm thinking about Trump's kind of 10% interest cap. And I don't think any of them in this room believe that's going to happen. But if anything like that does, it's going to push those individuals that we can't appropriately risk-based reprice into alternative lending solutions. We might find stablecoins finding a niche there as well. So it could potentially disintermediate payments, lending, and deposits. And so you need to be very aware of these tools and get involved in them early, right, so that you're not disintermediated.
Yeah, well said. Larry, one other question for you, kind of picking up on some of the recent discussions on this yield for stablecoins, which of course could change a little bit. The future that we're talking about is still uncertain. How do you see that in speaking with your financial institution customers, and how important do you think it is for regulators to address that topic?
So yield was already addressed by in Genius Act, and it explicitly said as an issuer of the stablecoin, you cannot pass yield directly to the holder of the stablecoin. What that didn't say was that you couldn't pass yield to a third-party intermediary. So stablecoins in a traditional crypto parlance, what a lot of them would do, I'm a stablecoin issuer, I make money by holding deposits or putting them in U.S. treasuries and earning yield on that because people give me the money so they can use their stablecoin. Since it's a very profitable business, I want people to have access to it. To have access to it, you have to have a distribution network. The traditional distribution network for stablecoins were crypto exchanges. So I might have a partnership with Coinbase where I pay Coinbase some sort of my revenue so they encourage their customers to trade stablecoins, right? Because then they make money on the trading. That kind of revenue agreement was not addressed within Genius. So what we found was that stablecoin issuers were passing rewards, yield, money back to the exchange, and the exchange was passing that directly to the holders of the stablecoin. Whether or not that gets addressed in the upcoming Clarity Act, which is being debated in Congress right now, and the bank lobby would like to have that loophole closed, it still doesn't solve the issue with yield because, again, this stuff is programmable money, and I can enter it into DeFi contracts where I can earn yield by entering into a liquidity pool or lending my stable coins out. And as these things start to work their way into retail transactions, which I don't think is going to be immediate, but you can imagine why a merchant might want to use a stablecoin. It's a much more efficient way of processing a transaction. You don't have to worry about chargeback and dispute, and the cost of that transaction might be 2 to 3 basis points versus a historical card transaction, which is a whole lot more. We might see merchants start to offering rewards for using stablecoins. So there's a lot of additional places that rewards or yield could come from outside of just that third-party loophole that everyone's talking about in Congress. So at the end of the day, I think yield finds a way. I think that's a bad argument to try to be chasing down. There's some historical relevance to like when money market funds were introduced or when banks were prohibited from offering people yield or rewards for signing up for a new checking account. They were giving away toasters. So I'm not sure the banking industry is really going to win the yield question. They might get locked down a bit, but I think there's bigger questions to answer.
By the way, I agree with that. I don't think we're going to win that argument. I think there's going to yield will, in one way or another, get paid. They'll find a way. I actually think the biggest threat to bank deposits is tokenized money market funds.
Yeah.
Right? When BlackRock and other big money market fund providers are tokenizing all their funds, they're paying yield, they're paying good yield, and I think we're going to see some movement there as well. So I agree with you. I think as a banking industry, we should think about how do we prepare and address and start solving for that rather than arguing against it.
And adopting them and selling those as solutions and products to your service. Even if it's through wealth management and you're offering a money market fund, then do that and earn some money that way.
Yeah, agreed.
Well said, both. So if we stay on the unique position that banks are in and we start to compare to some of the other different types of rails that are out there, with the OCC now licensing non-bank issuers as federal qualified stablecoin issuers, have we seen that banks have a natural advantage perhaps because they have historically had strong compliance infrastructure? What's your take? Larry, maybe I'll start with you.
Yeah, so banks have historically used regulation as a moat, and that's worked reasonably well. And regulation is important, right? We're a fully compliant business. That's super important. Stablecoin issuers and those kind of the fintechs have a disadvantage because they don't have that regulatory experience. That said, all of those companies, guess what? They're hiring compliance folks from the banking sector. So they're going to get up to speed with that. The Genius Act explicitly says that stablecoin issuers, whether you're a private stablecoin issuer, whether you're doing it through a subsidiary of a bank or a subsidiary of a credit union called a CUSO, they have to be compliant with BSA, AML, anti-money laundering, all of those, know your customer. They've got now the same regulatory requirements. So while it might take them a while to get as good as the banks in kind of managing those risks, they're going to get there. So that regulatory barrier is gone. They have a technological advantage because they are using systems that are a lot more efficient than kind of our, maybe 20-year, 30-year cores. We as banks are going to have to get up to speed on how to leverage that technology because we're going to be at a disadvantage, I think, from a technology standpoint, and we're no longer be on a level playing field. So I would say we need to look at adopting that technology, understanding that regulatory moves are not going to protect us anymore, and compete on a level playing field. But the good news is the fintechs are going to have to compete on a level playing field as well.
Yeah, I agree with that. I think, look, right now, for the moment, again, things are moving very rapidly. Our starting point as banks, we do have some advantages, right? One is our client base, our distribution. Yep. Building out the distribution takes a lot of time and scale. We have that. We have those relationships. So we have that. We do have the compliance, the risk management, the ability to scale in financial services and deploy at scale. We have trust, which is really critical. You talked about in the SVB scenario, right? There was a flight towards safety. If there is a stress event in this space, there will be a flight to safety. Banks have that trust right now. And then we also have those on and off ramps we talked about, right? We will live in a world of TradFi and DeFi for a period of time. And banks have that ability to bridge both of those worlds and do the on and off ramping. So I do think we should start from, okay, what are the advantages that we have and build out our solutions and capabilities. But I agree with your point as well, right? We have old technology. These fintechs have an innovation mindset. They're faster, they're more nimble, they have new technology. So my view is, let's cooperate, right? Like these firms are competitors, but they're also partners and they're also potential clients, right? How do we think about these relationships where instead of thinking about we're going to compete with them, how do we work together to deliver, at the end of the day, a better solution for our clients, right? And to me as a product person, shame on me if I can't figure out how to deliver a better product to my client that solves their problems and can't compete, with these fintechs. So I do think competition makes all of us better in the industry, and it keeps us all on our toes and delivering better solutions to our clients. So I welcome that competition as long as it's on a level playing field.
And one thing that's going to be a real advantage for banks is if you start to adopt this technology, and you will, for stablecoins or even tokenized deposits, because the way these things work, they don't work on kind of traditional ledgers. They work on a shared ledger, which means you're going to have to set up digital wallets. There's this big push and talk in the industry about moving away from account-based activity to wallet-based activity. So we need, as an industry, to be ready for that shift. And a lot of times that's kind of this through a blockchain that's attached as a side core to our traditional cores. If you think about how cores have evolved over the years, we went from these like on-prem mainframe systems to the cloud. Bank for International Settlements talking about this concept of a unified ledger. The regulated liability network was this idea of kind of a shared ledger platform amongst large banks. Whether or not we get there eventually where we're all sitting on kind of a shared ledger, I'll leave that up to the pundits, but I think we're headed that direction, and if you can adopt some of this technology and build those wallets, start to move to a wallet-based as opposed to account-based, you're going to be future-proof. You're going to kind of more future-proof the business than if you just stick with kind of the core business and technologies as we know it today.
Well said. In this section, I want to cover one more point on speed to market and the question around technology companies or crypto native firms. Do we think that they have a speed to market advantage, or what might we learn from them? And when you think about what it takes for a bank to be quick to market in this context?
Yeah, and so they do in terms of the development, right? So the point we were just making, they're nimbler, they're more innovative, they have that culture, and the newer technology. So in terms of developing capabilities and technology, clearly they're quicker speed to market. However, speed to market to me is not just developing a product or capability, but actually having it being used by clients. And that's where the bank, the ability to scale, the ability to distribute, the ability to get this in the hands of customers, that's where a bank has the benefit. And that's where I come back to, there's really a benefit to cooperating and bringing those two together. We both bring strengths. But yeah, so it depends. When you say speed to market, is it getting in the hands of the end customer, or is it developing the capability? So I think, and we both have advantages in that.
Well said. All right, so we'll turn to our next section, which is more on the financial reality of actually running these types of solutions. And I see some questions trickling in.
There's a lot of questions. Do we want to cover some of those?
And folks, please keep your questions coming in. If we don't have time to get to them all, we'll follow up after this session. So one aspect of the Genius Act is that stablecoin reserves must be held in the high quality liquid assets that you were talking about earlier. And given tokenized deposits can stay on the balance sheet and support a lending franchise, Larry, to what extent do you think this stablecoin model is less attractive for a bank's net interest margin?
For sure, it's less attractive for the net interest margin. There are other revenue sources associated with stablecoins, but it's not going to be nearly as attractive as being able to lend that money back out on a fractional reserve basis. So stablecoins will tie up liquidity. There is an opportunity for some banks, and some banks have gotten into custodying those stablecoin assets on their behalf. Right now, as an issuer of a stablecoin, you cannot rehypothecate those loans. They're fully reserved. They have to be sitting there for the benefit of the stablecoin customers. I think in the future, though, we're probably going to see a world where some of that, at least stablecoins, say if I'm a bank and I've got customers that have stable coins and I bring them onto the books, yeah, I can hold it on behalf of the customers. I can't right now today really bring them onto the books of the bank. However, if you think about a stable coin as a cash derivative, and if these things become ubiquitous and you can use it to pay vendors and use it to pay employees, it's just another cash instrument. There's no reason, I don't think, that we couldn't take a fully reserved stable coin onto our balance sheets and then lend it back out on a fractional reserve basis to purchase securities, et cetera. A lot of things would have to change from a regulatory standpoint for that to happen. But as it stands today, stablecoins do tie up a lot of liquidity in the system, which obviously puts pressure on lending, puts pressure on capital formation, and I think there's a general understanding and a more of an understanding in Congress and the traditional finance that could be a problem.
Great.
Now, the flip side is it does provide purchasers for U.S. Treasuries, and the government needs U.S. Treasury buyers to fund the business, but or the government, but that's another topic.
Well said. So if we look at kind of the other side here, more on the tokenized deposit side, so given they can enable 24/7 instant settlement, Elizabeth, how are your treasury teams adjusting liquidity coverage ratio models to account for the risk of a programmable bank run that could happen outside of Fedwire hours?
Yeah, we touched a little bit on that earlier. I think we're monitoring it, right? And seeing what the behavior is and thinking about how do we value these deposits, how do we manage them and monitor them. And also, as I said earlier, in many ways, it is similar to sort of what corporate treasurers have if they adopt sort of the real-time rails, right? So that ability to move money around the clock. Right now, we have not seen massive shifts, but very, very early in our own treasury department is monitoring it very carefully.
Mm-hmm. That's great. And I'm seeing a few audience questions around the impact of this on FX and kind of challenges that are arising through digital assets and opportunities perhaps as well. Do either of you have a perspective on this?
I would say, at least for U.S. stablecoins, they are all denominated in U.S. dollars, so there's no real FX component. There are other stablecoins in the world that are denominated in euros or others, so there could be FX components. I think that you do get into FX when you're transferring that U.S. dollar stablecoin to another country. Now, often in another country, people are looking to hold U.S. dollar denominated assets, but if they wanted to spend that locally, they've got to either off-ramp that and there's an FX component. There is some interesting ideas, and Visa is one of them in particular, where they're looking at putting a Visa debit card in front of that stablecoin transaction so they can handle that transaction at the point of sale, do the FX conversion. The merchant gets paid in the local currency, you don't have to worry about it. So, and likewise, you could kind of do a push to card, push it back into your local bank account, given this a debit card in local currency, and use stablecoin to kind of push it through Visa system, which I think was something just announced in last week or two. But there are opportunities to address FX, and anytime you've got FX, you've got spread and fee opportunities. So that's a plus.
Yeah, agreed. I think where the stable coins reach the fiat in the local market, that could be through a card, that could be through an account, that could be through a different type of wallet. I think that there are still those opportunities because ultimately that's how you're going to get it to a consumer or business using it on the other side. All right, so we're winding down on our time, and we can kind of weave in some of these questions coming through perhaps into your responses, folks. But if we think back to the beginning, and you've touched on this a little bit, Elizabeth, for those that are on the leading edge with the solution that's in market or proof of concept that's out there, what do you think it's going to take for that solution to really take hold and scale rather than just being a proof of concept?
Sure. Yeah, and I will weave it into sort of some of the questions here. One of the questions that's come up is are tokenized deposits and stablecoin a new income stream opportunity, or is it replacing conventional sort of the payments and deposit income and capabilities? And so, and this goes to that sort of lessons learned as we think about it. I actually think it's both, right? And I think we do need. So again, number one advice, sort of ground yourself in the customer. What's the problem that we're trying to solve? Don't unsolve solved problems, right? Again, it's tempting to use the technology and like the things we've solved for, like there's plenty of unsolved problems. So let's think about the customer. What are the frictions that still exist? What are the value-added opportunities that we can bring to market? So again, is it just replacing the existing revenue or creating new revenue streams? I do think it's both. One, on the one hand, the technology will become the pipes, the plumbing, right? I think it is fundamentally just better technology to replace. So as a bank, there's opportunity for efficiencies. We see a ton of opportunity even internally without even thinking about the end customer and greater revenue. There's an opportunity for us to save money, to be more efficient, to have operational benefits. And it will be better pipes and better plumbing for the end customer. But I do think it also brings greater revenue ways. Like, we can be creative. The ability to think about smart contracts, programmability, all of the functionality around the data and the capabilities. There's new revenue streams there. We don't fully know what they all are. We have to think about it. We have to be creative. But I do think it will be both. It will enable greater efficiencies and capabilities and better plumbing, both for ourselves and our customers, and it will enable value-added products and services we just could never do in the past, and now we have that opportunity to do it.
Well said. And Larry, I'll give you the final word today with my last question. So for those that are still on the edges, that are maybe monitoring or have not yet started to develop their strategy in this space, what is any kind of final parting words of advice that you would lend?
So for any technology to get implemented as a disruptive technology, you have to ask who benefits from it. And this is one of those technologies that everyone benefits from it. Banks can benefit from it, merchants can benefit from it, the end customer can benefit from it, governments can benefit from it. Like, across the board, there are benefits. There's also obviously risks. As a financial institution, you don't have to have a stablecoin offering, you don't have to have a solution, you have to have had thought about it. You have to have a informed decision around it, because if your board, your investors ask you why you didn't do something with the stablecoins in 2 years from now, you better have an answer, because it may be dependent on whether or not you're still in business. So, think about that. This is transformative technology. This is a new, faster payment rail. This is something that around the world is driving huge value and huge amounts of money movement. A lot of that still associated with crypto, but probably $10 trillion of it associated with true payment activity, most of that B2B, most of that cross-border. But $10 trillion and growing is nothing to sneeze at.
Thank you both for being here, and thank you all in the audience for your great questions. We'll be following up with those after the session, because I know we did run out of time, and a couple of us will be hanging around after. Thank you so much.
Thank you.